We all dream of financial prosperity, but what if I told you that it's possible not only to survive, but thrive during a recession? Welcome to Unreal Investments, where we're diving into an unconventional topic, how to get rich during a recession. We'll cover this topic in detail, from understanding what a recession is to diversification, in this 6-part video, so stay tuned until the end. But before we dive into today's video, here's a quick disclaimer. Please remember, I'm not a financial advisor, and so nothing we talk about in this video is financial advice, but rather my personal opinion. So before doing anything, do your own research and consult with a professional financial advisor. And as always, you can find useful links to help you on your journey in the description box below. With that over, let's get back into the video. Segment 1. Understand the recession. Recessions are more than just economic downturns. They're complex phenomena with far-reaching consequences. To navigate this challenging terrain effectively, it's essential to comprehend the ins and outs of what a recession entails. A recession is typically defined as a significant decline in economic activity that lasts for an extended period of time, often marked by 2 consecutive quarters of negative economic growth. It's like a prolonged winter for the economy, with reduced consumer spending, business investments, and job losses. Understanding the causes of a recession is fundamental. They can vary, but common triggers include financial crises, external shocks like natural disasters, or imbalances in the economy, such as excessive debt. Think of it as a domino effect, where one problem can lead to a cascade of economic challenges. Recognizing the signs of a recession is equally crucial. Watch for indicators like rising unemployment rates, falling consumer confidence, or a decline in industrial production. It's important to remember that recessions are a normal part of the economic cycle. They happen, they pass, and economies recover. While they bring their fair share of challenges, they also present opportunities for those who are well prepared and proactive. Segment 2. Rethink your financial mindset. In the face of a recession, your mindset becomes a powerful tool. It's not just about surviving, it's about thriving. And that begins with how you perceive and approach your financial situation. First, consider shifting from a scarcity mindset to an abundance mindset. A scarcity mindset is rooted in fear and focuses on limitations. Instead of dwelling on what you lack, focus on what you have and how you can make the most of it. Recessions, while challenging, can also be periods of innovation and transformation. Many successful businesses and inventions have emerged from times of crisis, like Airbnb and Uber were founded during economic downturns. This is a testament to the power of innovation and adaptability. So, maintain a positive outlook and stay open to creative solutions and new opportunities. Additionally, during a recession, there's often an increased emphasis on frugality and resourcefulness. Embrace this by reevaluating your spending habits and looking for ways to save money without sacrificing your well-being. It could mean cooking at home more often, cancelling unnecessary subscriptions, or finding cost-effective alternatives for your needs. Another aspect of rethinking your financial mindset is recognizing that wealth isn't solely about money. It's also about personal growth, relationships, and well-being. Use this time to invest in yourself, learn new skills, explore your passions, and strengthen your personal connections. Ultimately, during a recession, your mindset becomes a critical asset. Instead of seeing challenges as roadblocks, view them as stepping stones. By adopting an abundance mindset, embracing innovation, being resourcefulness, and investing in personal growth, you can position yourself not just to survive, but to thrive during these economic storms. Segment 3. Save and budget wisely. In the midst of a recession, financial stability becomes paramount. Saving and budgeting wisely are like building a fortress to protect your financial well-being. So here's what you need to do. 1. Build an emergency fund. Begin by establishing an emergency fund. This is your financial safety net, ready to catch you if unexpected expenses or emergencies arise. Aim to save at least 3 to 6 months worth of living expenses. It's your cushion against the unexpected. 2. Create a recession-proof budget. This involves reevaluating your spending habits and making strategic adjustments. Start by categorizing your expenses into essentials and non-essentials. Prioritize essential needs such as housing, utilities, groceries, and insurance. Allocate a reasonable portion of your income to these necessities. For non-essentials like dining out or entertainment, consider scaling back. Think of it as temporarily tightening your belt to weather the financial storm. Cutting down on discretionary spending can free up more resources to bolster your savings. 3. Track your spending. Tracking your spending is crucial. Use budgeting apps or spreadsheets to monitor where your money goes. This helps identify areas where you can cut back further. 4. Pay down debts strategically. If you have debt, create a plan to manage it strategically. Focus on high interest debts first, as they can drain your finances. Consider refinancing options or renegotiating with creditors if necessary. Reducing debt frees up more funds for saving and investing. 5. Automate your savings. Make saving a habit by automating it. Set up automatic transfers to your saving or investment accounts. Treating savings as a non-negotiable expense ensures that you consistently build your financial fortress. Segment 4. Invest strategically. Investing during a recession might seem counterintuitive, but it can be a potent strategy for building wealth. Here's how you can navigate the investment landscape strategically. Part 1. Identify undervalued assets. In a recession, many assets are undervalued, presenting buying opportunities. Think of it as a stock market sale. Companies that are fundamentally strong but currently facing market pessimism may offer stocks at discounted prices. Real estate properties too may be available at more affordable rates. Part 2. Dollar cost averaging. Dollar cost averaging is a disciplined approach. It involves investing a fixed amount of money at regular intervals, regardless of market conditions. During a recession, this strategy allows you to buy more shares when prices are low and fewer when prices are high. Over time, it averages out your purchase prices, potentially leading to better returns long term. Part 3. Focus on value investing. Value investing is like a treasure hunt for undervalued stocks. Look for companies with strong fundamentals like low debt, stable cash flow, and a history of consistent dividends. These are like the gold mines of the stock market. By investing in undervalued, financially healthy companies, you position yourself for potentially long-term gains. Part 4. Consider dividend stocks. Dividend stocks can provide steady income even during economic downturns. Companies that pay dividends often have established track records of profitability and financial stability. Part 5. Don't time the market. Timing the market is challenging, even for seasoned investors. Rather than trying to predict market bottoms or tops, focus on your long-term investment goals. Successful investing is more about time in the market rather than timing the market. Consistency and discipline can be your allies. Segment 5. Real estate opportunities. Real estate can be a cornerstone of your wealth building strategy during a recession. Contrary to the common misconception that real estate falters in economic downturns, there are unique opportunities that savvy investors can leverage. 1. Distressed properties. One of the primary advantages of a recession for real estate investors is the availability of distressed properties. These are properties facing financial difficulties, often resulting in forced sales or foreclosures. Distressed properties are typically sold at reduced prices, presenting excellent investment potential. 2. Real estate investment trusts. For those who prefer not to purchase physical properties, real estate investment trusts, also known as REITs, offer an alternative. REITs are like a collective investment in real estate, often specializing in specific property types, such as residential, commercial, or industrial. They provide a way to invest in real estate without the responsibility of property management. Even during a recession, REITs can offer steady income through dividends. 3. Cash flow properties. Investing in rental properties can provide a consistent stream of income, even during economic downturns. Focus on properties that generate positive cash flow, which are those that have rental income exceeding expenses. During a recession, demand for rental housing often increases as people opt for renting over buying homes. This can potentially boost your rental income. 4. Renovation and flipping. Recessionary periods can be an ideal time for property renovation and flipping. Properties that need a facelift can often be acquired at lower prices. With strategic improvements, you can enhance their value and sell for a profit. Just ensure you have a well thought out renovation plan and a budget in place before you do this. 5. Long-term perspective. Real estate is a long-term investment. While you might see immediate opportunities during a recession, the real reward often comes over time. Be patient and maintain long-term perspective when investing in real estate. Remember that real estate isn't a one-size-fits-all investment. Your approach should align with your financial goals, risk tolerance, and investment horizon. Real estate can be a robust addition to your investment portfolio, potentially providing both income and long-term capital appreciation. Segment 6. Diversify your portfolio. Diversifying your investment portfolio is like having a balanced diet for your financial health. It involves spreading your investments across different asset classes, reducing risk and potentially increasing your overall returns. Here's how you can diversify your portfolio effectively. Part 1. Spread across asset classes. Invest in a mix of asset classes such as stocks, bonds, real estate, and commodities. Each class has its own risk and return profile. While stocks can offer higher returns, they come with greater volatility. Bonds, on the other hand, provide stability, but typically offer low returns. Real estate and commodities can also add diversity to your portfolio. Part 2. Geographic diversification. Consider investments in various geographic regions. Different economies may perform differently during economic cycles. By investing internationally, you can reduce your exposure to the economic conditions of a single country. Part 3. Sector diversification. Within the stock market, diversify across different sectors or industries. Some sectors like technology or healthcare may perform well even during economic downturns, while others like hospitality or retail may be more vulnerable. Balancing your investments across sectors can help mitigate risk. Part 4. Risk tolerance alignment. Ensure your investment choices align with your risk tolerance and your financial goals. Diversification doesn't mean spreading your investments too thin. If you're risk averse, focus on more stable assets. If you're more comfortable with risk, consider allocating a portion of your portfolio to potentially higher yield investments. Part 5. Asset allocation. Develop a clear asset allocation strategy based on your goals and risk tolerance. This strategy should define how much of your portfolio is allocated to each asset class. Rebalance your portfolio periodically to maintain your desired asset allocation. Part 6. Seek professional advice. If you're unsure about how to diversify your portfolio effectively, consider consulting with a financial advisor. They can provide guidance tailored to your unique financial situation and goals. Diversifying your portfolio is an essential strategy for managing risk and optimizing returns. By spreading your investments across various asset classes, regions, sectors, and aligning them with your risk tolerance and goals, you create a robust financial foundation, allowing you to weather market fluctuations with greater confidence. In conclusion, getting rich during a recession isn't just a dream, it's a possibility. Embrace resilience, adaptability, and a growth mindset. Remember, challenges often come with opportunities. Seize them wisely, and you might find yourself on a path to financial prosperity even in the face of economic uncertainty. Thank you for joining us on Unreal Investments. If you found this video valuable, be sure to like, subscribe, and hit that notification bell. Stay tuned for more insightful content on financial success and wealth building. Until next time, stay financially empowered.